So we're going to talk about the 7 deadly investing sins, along with what you need to know about volatility, right? If you kind of watched the headlines in the markets this past week, there was volatility in spades, to say the least. We're going to talk about it, give you some historical perspective on it, along with a 3-step program to help you survive it. Joining me this week on Dollars and Cents is none other than Chet. Good morning. Welcome to the program.
Good morning. Thank you for having me. Glad to be back. We certainly have a lot to talk about this morning.
We do indeed. This is one of those shows where what we've got to talk about is to kind of work through some tougher topics, if you will.
Absolutely, yeah. This is not necessarily something we like to talk about, but it's happening and it's relevant and it's worthy of a discussion. That's for sure.
That is for sure. You know, I look back on some of the Sundays when I've been sitting in this booth, and obviously it wasn't this booth because now the studios are at Nelson Financial Planning. But you know, back in the day, you used to have to get in the car and drive all the way up to Maitland for the studios and be there in the Clear Channel or iHeartRadio studios. And yeah, there was certainly some Sundays where it was a little tougher to chew through the headlines, but that's what we do on this program.
Absolutely. I would imagine 2008 probably wasn't very fun.
2008, 9/11, the dot-com bursting, the COVID shutdown. You know, there's a list, and there'll be another list that will continue to grow over the years ahead. So welcome on into the program. This is, of course, Dollars and Cents, where we help you make sense out of all of life's decisions involving your money, and during times like this, help to bring some perspective on what actually is going on in the markets. And of course, we're one of Central Florida's longest running radio programs, having been with you through all of those aforementioned crises over the course of the past 35 plus years of this program. My name is Garris. I'm a certified financial planner, certified financial fiduciary. Joining me is one of the fellow certified financial fiduciaries at Nelson Financial Planning, Chet. And we're here to help you. So let's dig into it. A busy week, to say the least.
Absolutely. A very busy week. Lots of tariff announcements that I think came in a little bit higher than maybe the market expected. I sort of thought that these things may have been priced in, and we were sort of proven wrong on that front.
Well, and they did wind up being a little bit more draconian, obviously. And if you've been living under a rock, on Wednesday, you had the formal announcement of the tariffs. Obviously, created a pretty adverse reaction in the markets, in particular on Thursday, which continued over into Friday. That Thursday was the single worst day in the markets since March of 2020 during the course of the COVID shutdown. For that day on Thursday, the Dow was down about 4%, S&P 500 down 5%, the NASDAQ, which is more tech heavy, was down about 6%. So a lot to unpack here, and in particular is how other countries are reacting to these announcements. It looks like at first blush they don't seem to be rolling over, with China announcing that it's going to match the 34% right out of the gate.
Right. Yeah. No. They certainly don't seem to be rolling over and bending the knee to us, which I think may have been what the administration expected to some extent. Even getting China and Japan and South Korea to work with each other for probably the first time in history, so that may not be a good sign.
Tariffs are, at the end of the day, a form of taxes, and I think the discussion of who pays that tax, whether it's the foreign country, whether it's the business, or whether it's, at the end of the day, the consumer, is yet to be determined. It's certainly one of those times where we have seen many times where Washington policy or policy out of Washington certainly impacts the market. Most of the time you see it from the Federal Reserve, right?
Yeah, no, absolutely. When the Federal Reserve has a big a big effect on market movement one way or another. When they raise or lower rates, whether that be more times than the market priced in, or at a bigger variance than the market priced in, there can certainly be some big swings in the market.
Yeah, it's usually when it's a story out of Washington that impacts the market, it is in fact what the Federal Reserve is doing, raising rates or cutting rates. This one obviously not Federal Reserve related, although we'll have some thoughts on that here in a minute. But certainly federal policies can in fact roil the markets on a short-term basis. Perhaps the starkest one, and Chet, you mentioned, the global financial crisis of 2008 earlier in the program, and that I think is one of the clearer examples where you can have political decisions that certainly adversely impact the markets. And I remember that well. That was back when both my late father-in-law Jack Nelson and late PhD and Rollins professor Dr. Frank Dass were part of the organization. And I remember us sitting around in 2008 and trying to get a handle on kind of what was going on. And at that point, there was this bill, which was the TARP bill, which was the Troubled Asset Relief Program bill. And that was the one where they, kind of put billions out there to, back then the bailout bills were only billions. Now they're like trillions. But it was the one where, they were putting some money out to go in and shore up the banks. Right. And so, and I remember well, Frank and Jack and myself, we're sitting there on a Friday. We kind of gathered together because over the course of the weekend, there was this bill, the TARP bill, that was going to make its way through Congress. And it's funny, at the time, all three of us kind of came to the conclusion of, well, okay, fine, Congress is going to pass it. That's going to help to kind of stabilize things and kind of be able to at least move forward. And then I'll be darned, on that Monday, which was September 29th of 2008, guess what they did?
They didn't pass it.
They didn't pass it. Okay, bad idea.
Right.
Market proceeded to go down about 20% in the next 5 days. So obviously pretty dramatic.
Right.
They came to their senses on Friday of that week, October 3rd of 2008. But then, maybe a little late. Right. Damage done, unfortunately.
So the general consensus prior to the bill being voted on was that it would be passed. Is that typical?
Yeah. Yeah, that was the general consensus. That seemed like the obvious, right. Okay, to help stem some of the decline. So, but it was so we've seen it.
Right.
It's obviously a little different flavor of ice cream, but we've certainly seen this ice cream before, when we think about the numbers, we were talking about this at our morning huddle on Friday. At the office, when we looked at client portfolios, obviously down, but down maybe only 3%.
Right.
Versus Dow at 4%, S&P at 5%, NASDAQ at 6% for that particular day on Thursday. So it just underscores, some of those, these periods of time do a good job at reminding us about some of the investment fundamentals out there.
No, absolutely, and that's this times like these prove why diversification is so paramount. When you look at these indexes, especially the S&P 500 nowadays, it's so absolutely concentrated in a few companies versus a lot of our clients' portfolios own thousands of companies, and the proof is in the pudding here during these times.
Well, and a lot of the damage really is kind of happening on that large tech stuff, which hey, that's the stuff that went up the most of late. So as is usually the case when you run into market volatility, the stuff that has been going up the most of late usually is the stuff that unfortunately winds up going down the most during these tougher times. We encourage you to make sure to listen to the show from a couple weeks ago. We had a really in-depth discussion about tariffs, how they work, what the stats are. I mean, the reality is that there is a lot to unpack in this kaleidoscope issue of sorts. So I guess we would say stay tuned. There will be more to come as this discussion continues to unfold. The interesting thing is whether the Federal Reserve will ride to the rescue on all of this.
Right. We are in a position where we can lower rates. The question is, will the Federal Reserve choose to do that, or will they not? We will see.
Indeed. With that, we're going to take a break and continue the conversation here on Dollars and Cents with Joel Garris and Chet Coward of Nelson Financial Planning. Continuing to kind of work through all of this tariff conversation. Again, we encourage you to listen to the program a couple weeks ago that kind of dealt with sort of the nuts and bolts of what a tariff is and some of the ways in which you use tariffs now. Obviously, this past week's announcement, sort of working through the impact. Certainly, the data is real. I mean, the trade deficit in this country is about 1.1 trillion. Mm-hmm. That's not a made-up number. That's a real number. And certainly other countries impose tariffs on our products that generally have been historically a little bit higher than what we impose on them. But there's a global piece to all of this.
Absolutely, and while all of those numbers are certainly real, the impact of tariffs is certainly real as well. I mean, essentially, they're a tax on imported goods. You will see prices go up to some extent if these tariffs stick. We're a globalist world now. We are very reliant on international trade. The S&P 500, half of the companies in the index, or the average large company in the S&P 500 derives 50% of their revenue from outside of this country. So there will certainly be effects from these tariffs.
That's why you saw companies like Nike and Apple, and have a particularly tough week this past week. These are large global companies, and globalization is obviously a movement that is now 40, 50 years old, and certainly hard to unwind that in a week's time. That is for sure. The analogy that as you think through this a little bit, the analogy that I was making at the office this past week is, we're trying to get the cat back in the bag, right? Okay, but you ever had cats growing up?
Yep.
Cats growing up? Okay. Were they indoor cats or outdoor cats?
Outdoor cats.
They were outdoor cats. Okay, so they still had their claws. So sometimes we had a outdoor cat for many years when the kids were younger. He was actually more of a feral cat that we found as an infant. So if you ever mess with one of those, they will scratch.
They're independent.
Yeah, that's a kind word of saying it for the cat lovers out there. Yeah. They're independent. Yeah, I've used other adjectives when our cat was around, but it's like you're trying to get the cat back in the bag on this thing.
It's like putting the cat back in the bag, but the cat has rabies.
Yeah, the best case, you're going to get scratched.
Right.
Okay. Worst case, you might have some rabies, and I guess then that's where the Federal Reserve would perhaps have the rabies antidote in potentially cutting rates. So that, I think, is the interesting sort of backstory to all of this is, what is the Federal Reserve going to do? Are they going to ultimately or lower rates and in response to this? I don't think so. I think they're going to go slow. They've been going relatively slow as kind of the economy has flowed over the course of the past few years. So I'm not sure they're going to ride to the rescue with an antidote on this one just quite yet.
Yeah, I agree. I think we'll certainly see where this takes us later on in the year, but I think at this point, with how often the administration has flip-flopped on the tariff issue, it's probably too soon to make an adjustment, in terms of monetary policy at this point.
Well, and this is why we're here in the next segment. We're going to talk about volatility, and we're going to talk about, kind of a three-step plan, if you will, to avoid it. But, of course, as of the original air date of this program, we are 1 week out from the tax deadline. So don't forget, we still got that going on as well. Did you get your taxes done yet, Chet?
I did.
Excellent.
I did. Mine are fairly easy. I get them done as soon as I can. Some of the brokerages are not quick in issuing their 1099s, but yeah.
That is true. For many of our clients, we're still kind of waiting on some of that outside information, if you will. But here's the thing. We've been talking about April 15th, but I'm going to let all of the Floridians that are listening to this program in on a little secret. Deadline is actually May 1. Not April 15th. So just be aware that you may have a little bit more time to get your taxes done along the way. Here at the office, we obviously stuck to the April 15th deadline because it just gets too confusing. I think this is the third year in the past 6 years where for Floridians, it's been a different date.
Yep. There's always a hurricane or a pandemic. We can't catch a break in this state.
Correct.
We're going to be underwater in 5 years, and it's going to be June 15th.
Right.
We're filing from a boat.
Yeah, hopefully not. But yes, we're just one big sandbar out there in the ocean. But yeah, the reality is, folks, it is May 1, okay, if you are a Florida resident. So you've got a little bit extra time. But again, yeah, we're kind of sticking with that May 15th deadline simply because it's just, or the April 15th deadline, simply because it just changes all too much. So we'll shift gears. Let's get to the topic that we talked about at the beginning of the program. Some of these mistakes, and I think this is a good time to talk about this topic, is because this is a period of time where we traditionally see that investors can make mistakes that ultimately really do impact their long-term performance over time. So, so tell us a little bit about some of these. I guess this actually comes to us courtesy of an AARP story written by a guy by the name of Alan Roth, right?
Yep, it's an article by Alan Roth from AARP. He's a longtime financial correspondent for them, and I thought this was definitely worth a discussion, especially given what is going on. These mistakes can be made at any point, but it's definitely going to be more of an issue probably for the rest of this year.
Well, and that is true. Anytime you have volatility, it makes people nervous, and understandably so. And I guess that's kind of a core of the core behind any investment mistakes that people make is that basic human behavior.
Mm-hmm. Yeah, no, absolutely. And we've seen these countless times in good times and bad times, but during the bad times, they certainly they pop up more often. And I think it's important to talk about because they can certainly hurt performance if you let your emotions get to you during these volatile times.
Well, and the biggest of which is obviously the if you're buying high and selling low, right? I mean, that's the classic example. I think Warren Buffett's quote summarizes that pretty well. Be fearful when others are greedy. Be greedy when others are fearful. And right. I think that quote itself really kind of underscores those types of issues that people often run into, where they're selling at the wrong time and they're buying at the wrong time.
Yeah, I mean, I think it speaks to human nature a lot and it's obvious why people do this. When the market is going up and everybody's excited about investing, that's when everybody's excited about investing and they want to throw their money in. And then during fearful times, everybody wants to sell and move to cash. But that's actually exactly the opposite of what you would want to do, and it will hurt performance over the long term.
Well, and the reality is that what's really crucial about that is that most people, don't appreciate that when you look at the history of the market, what you'll find is that some of the market's single best days are often clustered around some of its single worst days. So when you go through the past several days in the market that we've had, you're going to have days where the market's going to kind of quickly trend the other way, and you miss those days, and that can really undermine that long-term performance over time.
Absolutely. And so next up, we've got chasing shiny objects. This one is one I've seen a lot over the last couple of years with the rise of meme coins, meme stocks, all of these random cryptocurrencies. I think about it, if you've heard FOMO, fear of missing out, that's often where I see people losing money, as well as sort of the gambling culture that I think especially my generation has sort of adopted. It's get rich quick. So we see this a lot. Memes and cryptos that have gone up 3x in the last year, and people are just now getting into them.
No, absolutely. Fair point. Well, we're going to take a break here on Dollars and Cents and return after these messages here on Dollars and Cents with Joel Garris and Chet Cowart of Nelson Financial Planning. Lots to talk about and break down on this week's program, Chet.
Absolutely. It's been extremely volatile in the past week with all of these tariffs announcements. There's just a lot of uncertainty in the market, and we're certainly feeling that, and that's the topic of this segment here.
No, that's exactly right. So I think, there is a lot to talk about when it comes to volatility. I mean, I think, Chet, when we were preparing for the program, this past week, you brought up the notion of, well, there's some math at play here that skews perspectives, if you will.
Yeah, no, absolutely. The Dow Jones is one of the indexes that I think we pay a lot of attention to, and for good reason. It's been around the longest, dating all the way back to 1896, so it certainly has a track record. So for example, a 1,000-point drop, it certainly creates a lot of headlines, and that sounds like a big number. People throw 1,000 points around, but it's important to have some mathematical perspective in terms of just how much the index has grown. It doesn't mean as much as it used to at one point, because 1,000 points, it's less than 2.5% of the index at its current value, where at one point, it would have been a 10% decline, at a smaller value of the index, a smaller size. So I think it's important to use percentages instead of just the actual point value that has dropped, because it creates a lot of fear that is probably unnecessary.
Yeah, I mean, that's always the case. I mean, sometimes the absolute numbers, particularly when we think about point declines in the market, don't quite mean as much as they used to, right? Because if there's been growth, then 1,000 points doesn't mean as much today as it did back 20 years ago. That's for sure. And of course, in today's world, there is a way to sort of measure fear, I'm not sure it's necessarily an accurate measure of fear per se, but it's certainly an accurate measure of investor sentiment. It was started in 1990, so been around a little bit, but not, certainly not as long as the Dow at 1896, but referred to as the VIX. So for those folks that maybe were listening a little bit to the media this past week, you might have heard them talk about the VIX. What that stands for is it is the Chicago Board Options Exchange Volatility Index, also, kind of known as the Fear Index, if you will. And what it measures is sort of the market's expectations for the relative strength of kind of what the near-term price changes are going to be in the S&P 500. The VIX can be traded using options, ETFs, things like that. It is ultimately calculated on a on a regular basis. I mean, every second of the market, it's getting calculated to sort of produce a measure of the 30-day, forward expected volatility of the U.S. market derived from kind of the pricing of the different companies in the S&P 500 in terms of index calls and puts and so things like that. So obviously it's got a convoluted formula. It's not just looking at, kind of the S&P companies, but it's really looking more at that call and put types of strategies that are going on. So it's a complicated formula. Of course, it has an index relationship, right?
Sure.
So if the VIX is high.
Right. It's really the easiest way to think about it is it's a measure of price action, I suppose would be a good way to say it. The quicker and more violent the swings of prices of different things, one way or another, good or bad, up or down, the VIX will go up, and if the market is trading more flat, then it will go down. It's more of just a measure of how violently prices of different assets are flipping around.
But definitely sort of like an inverse correlation, right?
Absolutely.
I mean, the VIX is going up and the market's going down. The market's going up. Chances are the VIX is going down. A VIX of say 20 or less, generally, everything's all calm. Start to get above 30, then you'd say, okay, things are getting a little bit more anxious.
Right.
Start to get above 40, okay, then people are pretty are pretty nervous. Interestingly, that 40 threshold not hit very often. Something like 60% of the time that VIX above 40 threshold has been hit was all the way back in the global financial crisis. Most years, I think like 25 of the past 34 years, the VIX doesn't, kind of break above 40. The VIX is definitely jumping around a lot right now.
Yes. Yeah, the VIX, seeing a number above 40 is certainly rare. We saw 30 on Thursday. So yeah, I mean, we're certainly at a period of fear right now, not quite at, world falling apart. But the VIX is certainly not happy with what's going on in the market right now.
Well, and yeah, I mean, for the day alone on Thursday, I think the VIX was up 40%. I think Friday morning it shot all the way up to 46.
Okay.
So early Friday morning it hit that 5-year high. So last time we saw that kind of a quick spike, it was last August, where it jumped up to 40. On fears of recession in China and all those kinds of things. So the VIX obviously gives us a good measure. I mean, I guess don't necessarily need a fancy stock market measure to tell us that people are nervous, but okay, the VIX would certainly support that contention that yes, in fact, people are nervous. But Chet, there's also something interesting that helps to put these numbers a little bit in perspective as well.
Yeah, I guess the question is how normal is some level of volatility? And I have an interesting stat here that I wasn't even aware of before this, and it's very telling of how the market tends to perform over time. So from 1984 to 2023, the S&P 500 index returned an average of 11.33% per year. Certainly a good return, so that's a 40-year period of time, plenty to gauge the performance of the market there. So how many years out of that 40-year period do you think the market returned between 9 and 12% to get around that 11.33%? It was not very often. There were only 3 years during the 40-year period when that happened. So I just think that's a very interesting stat that goes to show when we spread the time out a little bit, we can see great consistent results. But when you zoom in a little while, there's only 3 years within that long period of time where the market actually performed at that percentage point. It would have been a lot higher or a lot lower in most of the years, throughout that period of time.
And that's a pretty good range that statistic has. I mean, so if your annualized return over a 40-year period is 11%, and only 3 out of those 40 years it was within even a percentage or so of that 11% number, then I guess that is a nice segue to kind of one of the parts of our 3-step plan to help minimize or I guess manage volatility. And boy, that statistic would certainly suggest you want to continue to be consistent in your investment objectives, because only through consistency over that 40-year period of time were you able to get that return. Otherwise, you would have wound up more likely than not with a lot less.
Yeah, no, I mean, I think that stat perfectly illustrates the point of how hard it is to time the market, and we've certainly tried to drive that home so many times. Just the notion of dollar cost averaging, investing often over a long period of time. If you're in there for that whole 40-year period of time, you've got a great return. If you try to time it year to year, you would probably have picked some bad years in there and not done as well.
More often than not, you're gonna miss it, because the reality is timing the market requires 2 decisions that you must get right: when to get out and when to get back in. And I'm telling you, the harder one is the when to get back in, because we see it all the time. And of course, that leads us to the other sort of piece of our 3-step program to try and survive volatility, and that is diversification. We talked about this at the beginning of the program. Not being down as much as the overall markets. That is a credit to having a diversified, balanced portfolio that's got some conservative parts in there as well. And then, of course, the 3rd step would be small doses, if you will, of the media, because right now they are selling fear. And there's a lot of fear out there, and fear is always easier to sell, and it drives up ratings. So just be careful. Consume that in small doses. With that, we're going to take a break here on Dollars and Cents with Joel Garris and Chet Howard of Nelson Financial Planning. I think it's important, Chet, that we kind of recap, what we were talking about in that prior segment, because there is a lot of volatility. We were talking about sort of the traditional sort of measure that's been around since 1990, the VIX, and kind of what that measure and thinking about that, and the spike up that we saw, particularly even Friday morning going above that 40 level, and then on Thursday throughout the day having that sort of fear, what the media refers to as the fear index, going up by 40% in that single day. Not unlike the spike that we saw last August, where it broke above 40 as a result of fears of recession in China and things like that. But, important to have a game plan, right? In order to help to, get through these periods of time. And we were kind of making a three-step plan. So first on that, first step in that plan is what?
It's going to be diversification, probably and arguably the most important thing throughout the list. And I think this year is also interesting because it's proving how important that is for one of the first times in a long time, given the fact that our domestic economy, our domestic market is struggling here a little bit, and the international markets are vastly outperforming. So, if you're not diversified, whether that be geographically or just in the various companies throughout the country, then you will certainly feel the pain more than someone who is.
Well, that's very true, because a lot of this is hitting disproportionately in the technology sector and those types of areas that were the areas that ran up. And so that's why, for a long time on this show, we've been talking about making sure that you as an investor have a good handle on what your diversification is. And it's not just how much I've got in stocks and how much I've got in bonds, but you've got to dig deeper, because if you've got a portfolio where on the stock side that you are heavy on these large technology companies. I mean, take a look at just think about the S&P 500 index.
Right.
7 companies, all of which happen to be of roughly the same ilk, the Magnificent Seven as they are described. Big part of the performance last year of the S&P 500, but
Absolutely.
also big part of the decline right now.
Yeah, they're 3.5x. They're down 3.5x more than the index as a whole. Those Mag 7 companies, they have certainly ballooned up and been the driver of market performance for quite a while now. But in these times, we're seeing them fall quite disproportionately to the overall market.
Got to dig in. Got to have an understanding of not just stocks versus bonds in your portfolio, but sectors, and then, Chet, as you pointed out, geographic regions as well. And I think those are two things that kind of people have sort of been forgetting. What's next in our three-step plan to help manage through volatile times?
So equally as important here is going to be consistency. That's what we're mostly talking about, not trying to time the market. Investing often and over the long term is where your performance is going to come from. Trying to time the market, getting in and out, I can guarantee you will be wrong. It is extremely hard to do, and your emotions will get in the way. And investing consistently is the only way that you are going to be able to get results on a consistent basis.
Well, and Chet, certainly the statistic you shared earlier in the program was pretty important. I mean, you look at the S&P 500 over the past 40 years. 11%, a little bit over 11% annualized return.
Right.
Only 3 of the years in that 40-year period did it come within a point or so of that 11%.
Right.
So that means all the other years it was either going up a lot more or down a lot more, or whatever the case may be, but very easy to be inconsistent in that kind of background.
Right. That doesn't mean that you could just pick any one of those 40 years and you would have gotten 11.33%. You had to have been in there that whole time to get that. And think about the math there. If the average comes out to that number and only 3 out of the 40 years were in that range of percentages, all of the other years were vastly different.
Sure.
So you need to be in there for all of them, or else your performance is not going to track that number.
And then lastly, the third of our three-step plan or program, if you will, to sort of navigate volatile times is, small doses of the media right now is probably a good idea. Because particularly in today's world, I mean, media consumption can be all-consuming.
Right.
And it's so ever present, particularly with our cell phones, that it makes it hard to stay focused.
Yeah, no, you can't escape it, and it doesn't mean what it used to mean. That used to mean turn off Fox News, turn off CNN, turn the TV off, and go for a walk. But nowadays, you've got the media machine in your pocket at all times. It's much harder to escape it, especially with social media. It's not the same as it was.
Well, and all of that, I mean, obviously having a three-step plan to help navigate through volatility, avoid some of these deadly sins that we were talking about. We talked a little bit about them earlier in the program, the notion of buying high and selling low. As you were talking about, the notion of kind of chasing that, thing, that shiny object, if you will, for the fear of missing out. But there's also a host of others, too.
Right. Yeah, no, there absolutely is. Next one we were going to talk about is confusing knowledge with unique knowledge. I see this. I think in my personal experience, right before the market began to correct, I received the most calls from investors wanting to pile money into tech companies, and I think it goes to show. It's sort of similar to chasing shiny objects. Everybody wants to get in when the run up is already over, and it reminds me, we've all heard the saying that it's priced in. The market knows everything. And to a certain extent, that can be true, especially in this case. It's AI, for example. Let's say that we believe that AI is the future. It's not going anywhere. That may be true, but at the same time, you got to understand that at some point it may not be the best time to dump all of your eggs in one basket.
Well, following that herd mentality, right, is a great way to get trampled.
Right.
So you want to kind of avoid that as well. I mean, we the thing that I often that we often see at the office as well is sort of the suspension of common sense. There's a lot of investment products out there that talk about what they can do, what they can't do, and the reality is that in order for a lot of these different investment products out there to work as they're described, so some of these involving, you get all the upside of the market, none of the downside risk, those types of things, you got to suspend common sense in order to believe that is truly how those types of products are going to work, because there's much more to what's going on in those products, that's for sure.
Yeah, no, and we've all heard the saying, if it's too good to be true, it probably is. But, we can say that as much as we want. At the same time, when you hear that, you want to believe it. And oftentimes you can convince yourself that it is true. But it is certainly not. It reminds me of all of these subscription services or people on YouTube or Instagram that I see, pay me X amount of dollars per month, and I'll teach you the secrets of the stock market and how I beat the index every single year. But I think if that were true and they were doing that, they would be off spending their billions somewhere else and not peddling their course.
Yeah, you wouldn't have to sell it for $39.99.
Yeah.
You'd be, you'd just be working off of your own trading account, if you will.
Right.
So, I mean, I think all of those are traps that that folks find themselves in, and at the end of the day, speculation is not to be confused with investing. That's for sure.
Absolutely. This ties hand in hand with chasing shiny objects. I see investors nowadays speculating, gambling, however you want to say it, much more than in the past. The rise of meme coins, meme stocks, all of these random cryptocurrencies. I wouldn't confuse speculation with investing. If you think about a traditional stock from a company that produces goods and services that we use every day, the price of that stock is backed by fundamentals of the company. That's revenue earned. That's passed back to you via dividends, capital gains. It means something. Where Bitcoin, for example, owning it is really just speculating that the price in the future will be greater than it is today. There's no earnings behind it. There's no company behind it. And fundamentally, there's nothing wrong with speculative investing. Just know what you're doing, know what you're getting yourself into, and don't make it your whole net worth.
Key distinction, that is for sure. So with that, we're going to wrap it on up. We will be back next week to cover this coming week's headlines in detail here on Dollars and Cents. This has been Joel Garris and Chet Coward of Nelson Financial Planning. Make sure you check out our website at nelsonfinancialplanning.com and schedule a free conversation to see how we might be able to help you navigate these times.